My screen is going
Hey, Jolynn.
be hot.
So everything's fine.
Did I tell you that this show will be sponsored by lemon chiffons?
You see the vibe, though, that you could only partly see in my cup. I guess I have to do it in front of me. But guess what, Jolynn? While we're sipping lemon chiffons, or I don't know what to call this, because I don't think that this is, part of the on brand for lemon chiffon, but we're live. Tastes so good. But, I felt like we should just invite a guest with us. People have been seeing photos and videos and everything else. So
It's forced.
they said that they were forced. I don't believe that by any shape, form, or fashion of the imagination. But coming to the stage, y'all, it is me. Oh, no, in the Matrix. Oh! We got Kiki in the building.
What up?
We got London on the track. What's up, everybody? This is Mark Monroe, and I am accompanied by my wonderful co-host and co-producer, and also very good friend and best friends, kind of like siblings, the wonderful Jolynn.
What's up? jolyngc in the place to be, feeling lovely. How you doing, Mark? How you doing, Kiki?
I'm good. Well, I just saw that I was actually frozen over there on my screen. So
that's why it took me so long. That's why I kept dancing. I was waiting for you to unfreeze.
It was wait, did you see my face though? I felt like I was one of those internet memes or something like that.
I saw it.
And on top of that, I think we have a sniper in the building. Yo, get your scopes ready.
You ready?
Hey, y'all.
Yo, I'm ducking for cover because, we brought Kiki on board with us because she's been visiting in town. So, of course, we had to have sis in town just to come hang out with us and to hang out with each and every single one of you, the cousins, for Trade Talk Tuesday, a show where we get to talk about not only what's going on in the market, but then also how is it that we can prepare. And, of course, in today's episode, we definitely got to prepare. And, we're going to hear some things also. So before we get it started, Jolynn, guess who was first today?
I'm just going to go with Reggie.
It was.
Who's
Hey, Reggie, how you doing?
That's the question. You know what? Hashtag who is Reggie?
Reggie, you need to identify yourself.
Yes. Oh, and did they spell anything today?
Nah, bruh.
Did not. But it was a good try.
Where are people calling or coming in from? That's what I want.
I was going to ask that. So shout out to where you're from. I see that people are definitely throwing up Stocks of Freedom in the building. So, I mean, hey, they see you out here. They see you. So we got a lot of Stocks of Freedom. We have, let's see here. Oh, wait, hey, Reggie and Butter Bay. Okay. Okay. We got Atlanta coming into the building. We got Hawaii.
Hawaii. Okay.
Shout out to Hawaii. We got DMV. We got Philly. We got Dallas, Texas, North Carolina, Miami Gardens, Lafayette, Louisiana. Oh, Seattle, Washington. So somebody in our own backyard. That's what's up.
I'm from Seattle. Who is that? Do I know?
Let's see here. We got
Kwame from Ghana. Edison.
I couldn't find it.
I know.
We got Long Island in the building. It's coming in so fast.
Y'all are coming in hot.
Yo, it's coming in hot. We got Carson, California. We've got Cleveland, Ohio.
Hey, y'all.
Wait. Okay, we got Tremaine in the building, all the way from Seattle, Washington. Principal Tremaine.
Tremaine, what it do?
Who's I think he's the principal of one of the most innovative schools in the city, Maritime School. So that's dope. We got somebody coming all the way from Jamaica, Montgomery, Alabama, Bedside, Brooklyn, Trinidad and Tobago. We in the building.
Trinidad. What
we
up?
got Atlanta. Oh, okay. Trinidad, they represented. We got people in from the Sept. Okay. Ghana, Texas. That's a first. I've never seen that before.
Ghana and Texas.
I never heard of that.
Yeah, I never heard of that either. That's interesting.
Guam, shout out to Guam.
Yes, we got Harlem, Toronto in the building, Memphis, Tennessee. Okay. And then, of course, we got a ton of, we even have somebody from Panama, Baton Rouge, Louisiana. But then we also have a lot of folks from Stocks to Freedom Land. So this should be interesting. Yo, Jolynn, how are you doing today?
I'm feeling lovely. I'm good. I'm real good, actually.
Okay.
Still sponsored by Lemon Chiffon.
You said sponsored by Lemon Chiffon. Yo, can we actually come up with a drink title here?
What's in it?
Sparkling water and lemonade.
Let's call that
Blackberry lemonade, by the way.
Blackberry lemonade. All right, give me. I can't do it on the spot. You know, I can't do it on cue. I got to be in the vibe. Got to be in the zone.
Well, let's see what the cousins say. Like, if you were to name give a name to this drink that's non-alcoholic, what would it be?
I don't got no sugar in it either.
No.
I know. You gotta tell them that part.
There's no sugar in the drink.
There you go.
All right, so how are you doing today?
Free.
Feeling great. Yo,
I see.
Seattle.
She keeps looking out at her phone. Okay.
You already know why. You know the vibes.
We know the vibes. We know the vibes. All right. Y'all, if you haven't subscribed yet, go ahead and hit that subscribe button. And if you like the content, go ahead and hit the like button. If you think we can do better, let us know. We're always here for room for improvement. And on top of that, if you want to be in the know, like our cousin Reggie, that's always just like 100% on it, go ahead and hit that bell and go ahead and hit, I think it's all. So that way you get all the notifications. We're not going to flood you or spam you with a bunch of notifications. But whenever we post a video or whenever we go live, you're in the know. So there you have it.
Okay, we got a name. Someone called it, what was it? Black Fizzle.
Somebody called it Come Up Smack. Black and water. Oh, wow. Wish juice. Oh, wow.
Black and a twist.
Blacker the berry, sweeter the juice. Non-potable. Skinny red Kool-Aid.
I can't.
Wakanda Dede. Bubbles and berries lemonade.
Somebody said diabetic delight.
Diabetic delight. Oh, Lord. Hey. Come here.
I'm just trying to get his bid in.
Yeah. What is it? What should it be called, Butter? What should it be called? It's not going to be called Wolf. That's not going to happen. All right. So, Jolynn, how do we do in these markets today? Go lay down.
So, today, the market, honestly, the market was just like, yo, Brother Jerome, what you going to say? And they're standing like this, waiting. So, it was kind of uneventful, but we got the Dow coming in at negative 94.42 points. S&P 500 was negative 8.56 points. And the NASDAQ took a little breather, y'all. It was negative 101.29 points. We got the VIX coming in at 17.02, and the 10-year Treasury note is at 1.49%. Heading on over to sector performance. As you know, there are 11 sectors. We track the top 3 and the bottom 3 so we can see what that rotation is looking like. And we got energy, industrials, and utilities leading the pack. And for the bottom feeders, we have communication services, technology, and real estate. We'll talk a little bit about real estate a little later, Miss Kiki. Anyway, now for pick performance, you can find our picks on our IG page at That Come Up Series. You just got to scroll through. You'll find all the pick lists, the latest one, which is due for an update soon. So stay tuned for that. We got XPO, Boeing, and MasterCard coming in at the top 3. And for the bottom 3, we have CWeb, CRISPR, and Roku. That takes up all of the bottom space. Most of them were on the red, honestly. There were only a few that were green, but that's okay. Now, y'all ready for some Black history, some triple Black history?
Oh, yeah, let's do this. You said triple Black history?
Always.
Oh.
Always. Okay. All right, we're going to shout out to Brian Pyatt, the Come Up Series historian. He likes to keep it extra Black. So we got Juneteenth 101. I hope y'all are ready. Juneteenth is actually coming up. So I hope y'all got your swag. I hope y'all got your plans. I got your meal set up, celebration, get the drums out, whatever you got to do, you need to celebrate, okay? Do not act brand new on Juneteenth. All right, Juneteenth is officially recognized in 48 states and celebrated on June 19th. Shout out to the state of Washington and shout out to Governor Jay Inslee, because Governor Jay was like, now look, we about to make this a state holiday. So here we are. Washington State is a part of that 48, y'all. Another reason why to move out here potentially. Anyway, the holiday observes the end of slavery in the U.S. when slaves in Galveston, Texas were finally informed of their freedom upon the arrival of federal troops on June 19th, 1865. 2 years after President Abraham Lincoln signed the Emancipation Proclamation about 2 months after the end of the Civil War. Y'all should probably look up the true reason why Abraham Lincoln signed that. It was not about freeing us. So I'm just leave it at that. Juneteenth, a portmanteau of June and 19th, is an annual celebration that commemorates a specific date, namely June 19th, 1865, the day many enslaved people in Texas learned they had been freed. President Lincoln signed the Emancipation Proclamation on January 1st, 1863, announcing that those who were enslaved shall be thenceforth, and forever free. But the proclamation didn't immediately apply in certain areas, including sectionist states like Texas, which had left the Union and joined the Confederacy during the Civil War. It took another 2 years for the news to go into effect in Texas. The Civil War ended in April 1865, and 2 months later, on June 19th, 1865, Major General Gordon Granger of the Union Army issued General Order Number 3 in Galveston, Texas, with Granger saying, "The people of Texas are informed that, in accordance with a proclamation from the Executive of the United States, all slaves are free." Slavery was formally abolished after Congress ratified the 13th Amendment to the United States Constitution nearly 6 months later on December 6, 1865. Freed slaves marked June 19th the following year, kicking off the first celebration of Juneteenth. Texas was the first state to establish Juneteenth as a state holiday. The late Representative Al Edwards of Houston, a Democratic congressman, wrote and sponsored a bill calling for Emancipation Day in Texas to be recognized as a legal holiday. He filed Bill 1016 in February 1979, and it passed in the Texas House of Representatives and Texas Senate the following May. Texas Republican Governor William Clement signed the bill in June 1979, and the bill officially went into effect on January 1st, 1980. Like legit almost a year before I was born. As of now, 48 states, along with the District of Columbia, recognize Juneteenth as a holiday or observance. Shout out to all those who are free in their mind, free physically, we're not in bondage. And also shout out to our brothers and sisters who are currently incarcerated. We're holding you down too in honor of Juneteenth. So, Mark, Kiki, what y'all got planned for Juneteenth?
Family, reflection, and on top of that, celebration.
All right, Kiki, what you got planned?
What he said.
All right, well,
what you got planned? Like, are you going to be doing are we doing the Emoji Fest this year?
I'm gonna get into some things, but the number one thing that I'm gonna be doing in honor of Juneteenth is I have 2 dope friends who are also artists. They have a gallery. It's called the WOW Gallery, Wonder Women Gallery, and it's in downtown Seattle, and they are opening their doors. And so we are having a white party that it's sold out completely. So even if you were in town, you can't get a ticket.
Can we talk about who some of those artists that are going to be premiered there?
It's Hiawatha D. So y'all have seen his artwork throughout. If you go throughout all the old Come Up series, you'll see some artwork of the 4 little girls in the background. That is a limited edition piece that I have. I have the number 1 edition of 2 of Hiawatha D's pieces because your girl is a collector out here. So, when I go to the white party, I'm going to be in the section where the collectors are. I get to see who all the other collectors are. And, I get to see so does everyone else that gets to go, but you get to see like all the new art. They're going to be having day retreats. So it's going to be fun. You know how we look in white, y'all. Okay, melanin stays popping. So I'm ready. Got my outfit. I'm waiting for to drop off these shoes and to stop playing with me. This order is hella late.
The stunt campaign is still in full effect.
Always. Always.
All right. Y'all ready?
Been ready.
Pew, pew.
Hey, there it is. Okay. So let's give a quick little breakdown, shall we? Because there's a lot that's on our table of what to discuss. Now, I think the question that's on everybody's mind, especially going into what took place today, was we saw a sell-off. And it's interesting, we kind of like reverted back to where we rallied from the day before, in which that the NASDAQ went up by, I think, by 105 points. I think it came down by 101, I think, today. And it's like we've been seeing over the course period of time a sector rotation that's been happening as we move into quadruple witching. So now it's always funny. It always seems to be so funny where it's like everybody talks so negatively about the Fed and everything else, but then as we get closer towards the Fed's meetings, everybody gets quiet and they like, what they gonna do? Like, what are they gonna do? Are they coming for us?
Let's talk about what they need to do, though.
Good question. So it comes down to four scenarios. It comes down to four scenarios in which that we've kind of plotted out. So let's do a quick breakdown. Now, a little while back, we were talking about tapering. And so we're looking at, well, I'm actually going to roll it back a little bit further for everybody. Remember when I did that episode called Seasonality?
Yeesh.
Where we were talking about, like, you know, what happens when things come out, when they fall out of favor, and then when they come back into favor. Mm-hmm. Jolyn, are you still there?
Yeah, I'm here. I can hear you, but your screen is kind of frozen, but I hear you.
Okay. You know, I may have something running on in the background. I may have to check that out. All right. So when we think about it, though, it's like, so now the sentiment has slightly changed. Like where we were going on the seasonality factor, where like if you think about it during the spring and the summer months, that's typically, if you look at most of your tech and consumer discretionary stocks, they start to wake up. Now, beforehand, earlier on in the year, we start to see things like, for example, you know, we start to see that where tech becomes less loved, consumer discretionary becomes less loved. We start focusing on things like financials, retail, consumer staples, some energy stocks and everything else. Because of course, you can predict the weather, you can predict the price of oil. And if you can predict the price of oil, especially looking at OPEC and say, for example, dollar per barrel, then essentially we start to see a gravitation towards those sectors. And so when we start seeing risk come onto the table, like, for example, things of economics, AKA things like the Fed, like inflation, those types of things, now everybody starts to get scared. Now, there's typically a few sectors in which that people start to float over to. They tend to go towards commodities. Why do they go to commodities? 9 times out of 10, commodities typically suck. But then when you need to de-risk yourself, or when you need to pull risk off of the table, but you still want to be active in the market, you go to a place like commodities. What are those things? Like oil and natural gas. And then another place in where people were hiding earlier this year were in places like materials. Now, why were they hiding in materials? Of course, duh. Inflation goes up, then of course the materials go up. So for example, shout outs to, we're not gonna say it a little louder. What's
Home Depot.
Oh, okay. All right.
There it is.
Shout outs to Home Depot because of the fact that they had a huge bump and a huge spike this year. Y'all did phenomenal. Because of lumber, and essentially the price of lumber went up, then ultimately places in which that where you can see a higher premium, then ultimately that would hit places like Home Depot, Lowe's. Now I think Lowe's is kind of like slightly underperformed Home Depot. Okay, so we're gonna get that base. All right, there it is. All right, so Home Depot has kind of outperformed Lowe's, but they've pretty much been great performers in comparison to tech. Now we're starting to get to a point where inflation fears are starting to kind of like subside. And I think I talked about this a little bit last week, where it's like, all right, well, we live in this 24-hour news cycle. When you keep hearing about this topic of inflation, you start to desensitize people a little bit. People start to become a little bit desensitized. It's like, all right, you know, if I told you the sky is falling and the sky hasn't fallen yet, And then I keep telling you, you're like, okay, Mark, we get it. The sky is falling. You become less desensitized. Now that inflation is here, we've seen like little pieces of inflation here. Now we're at a point where it's just like, okay, now where do we go from this point? We've already been talking about inflation. So the market was already pricing in inflation behavior. So heavy inflation, whether for the temporary or for the long term. So we start to see these spikes. Now, typically when you see rapid spikes, then ultimately you start to see the drops as rapid as well. So remember that time when we saw the 10-year, and I guess, knowing Jolynn, since it's Trade Talk Tuesday, she would want me
you already know
a 10-year.
Already know. Run that chart.
Oh my gosh. Let's see here. It's wow. Give me one quick second. Yeah, bar chart is not having it with me today.
Yo, if this was radio, we couldn't even have no dead silence. So anyway,
I know, right? We would like be like, we're gonna have to go to commercial break or something like that.
Right. Everyone was asking what my shirt says. My shirt says ungentrified. Got it from Queen Care, same place where Kiki and I got the body scrub. Yo, Kiki, are you feeling silky smooth?
Yo, that body scrub, y'all can go ahead and check out my girl website because that shea cream, Jesus, let me just tell y'all, got me right.
Okay. So we got it. So we're going to pull up a US 10-year chart. So as quickly as we saw the US 10, so this is the US 10-year year to date. So if I pull up the year to date chart, here's where we are. So as you can see, we spiked all the way up to about 1.75 in the US 10-year. And then we kind of like we've been on a steady decline ever since. Now, here we find ourselves at an inflection point. We find ourselves at a huge inflection point. We're kind of like in pretty much a drop zone, no man's land territory. Now, where we could get back up to is about a 1.5, 1.6, and that's where it's been trying to creep back up to. But if you get something from the Fed tomorrow, and which we're going to get into, then essentially you could be seeing this either go higher on the yield or you could be seeing it drop lower. Now, here's the reason why that we're talking about this narrative of the US 10-year. So like I said, a lot of folks have been getting desensitized to it. You saw a lot of institutional money that was trading it. Shout outs to Morgan Stanley. We see you. But at the same token, now it's going to come down to the Fed because now the Fed has got to make one of 4 decisions tomorrow. Well, they're already having the meeting, so I guess we'll find out what they discussed in their meeting. So here are 4 scenarios in which that can happen from the Fed as it pertains to their decision. Now, we've been hearing this thing as it pertains to tapering. Don't worry, I'll get to that in a second. But let's just focus on rates. The Fed has 2 decisions when it comes to rates. Either 1, they're going to raise the rates, or 2, they're going to keep rates as they are. There is no cut rates or anything like that. That's not going to happen. It's either going to be we're going to raise rates by a quarter basis point, or essentially we're going to just leave them as the same. We see that there's a lot of economic data out there, especially looking at unemployment, where essentially there's still not enough data though that we see the economy recovering. We still don't see it recovering in places in which that we should be seeing it. Or if they say that we're going to raise rates, they're saying, hey, we see that unemployment starting to do some clawback, especially since we saw 9.1 jobs sitting there unfilled, though that I believe that number is much higher. Then essentially you're going to say, all right, well, we see that the economic recovery has definitely become strong enough to the point where we feel confident where we can start raising rates. Here's the reason why it's always been interesting for the Fed. If you raise rates too soon, then you can cause the market to overheat. If you raise rates too slow, then also at the same token, you can significantly slow down growth or ultimately also overheat the market. So the Fed is going to be kind of doing this balancing act where they're steadily, whenever something happens, it's their duty to make sure that everything becomes balanced. Now, when things become imbalanced, then you can start to see some volatility. Now, what does that volatility look like? Uncertainty in the market. Now, what did we say a long time ago back in 2020 about the markets? The market does not like
uncertainty.
Bingo. It does not like uncertainty. And the reason why it doesn't like uncertainty is because the market typically projects things 6 to 9 months out. Now, if it can't pick that up, then 9 times out of 10, if the market is very uncertain,
the market goes down.
Now, if the market is very much so certain,
skyrocket.
Bingo. So that's one of the main reasons why it's all about what the Fed is going to say tomorrow as it pertains to, hey, are we still on course for keeping rates as they are? Or are we going to be at a place where it's like, all right, maybe it's time for us to start selling, because now that starts to give weight to maybe they're doing this because of the fact that they see something even further, which leads me into my second point. Inflation. Was inflation temporary, or is it something that's here to stay for a little bit longer? You know, on both sides of Wall Street, you're hearing on one side, oh yeah, it's definitely here to stay. It's not going anywhere. You guys see what's happening in the stores. This is just going to become the new normal. And on the other side, you're having folks saying, look, y'all, temporary moment. Yeah, we see some spikes in prices at the store and everything else, but sooner or later, we'll come back to normal. So now the question is going to be, who's right? In some cases, we're not going to know about these things in just one decision by the Fed. What the Fed is doing is they're projecting as it pertains to their balance sheet, which leads us into the final piece, tapering. Now, for those of you that don't understand what the Fed is all about, again, I mentioned that the Fed is always about keeping things on a monetary policy side balanced. And when there's balance in the market, then things can flourish pretty well. When there's an imbalance in the market, then things can get a little bit dicey. So what has the Fed been doing? What did they do in 2020 to ultimately keep the markets balanced? Well, they bought up a lot of corporate debt from companies that were struggling. They also bought up a lot of mortgage debt from like companies that owned it, or also in some cases in retail, on the retail side, for mortgage-based debt from other different divisions, like other companies like Take Your Fannie Mae's and everything else. And the reason why they did that was because, I mean, they knew that if something like this became a global pandemic, then ultimately when it hit home on the US forefront, they would need to give some type of quantitative easing to the market so that way they can keep the markets calm. Now, the question is, have they overstayed their welcome? And is it time to let that pressure valve go? The Fed has said, we're not going to do this until we reach a point of that's a significant amount of certainty where we believe that the economy can literally go on a course where it starts to roar back. So here's where we sit. Now that the Fed has bought up all this debt, now let's play a game, shall we?
Go for it.
If I am the Fed, and we'll say that Kiki's the investor and Jolyn, you're the company.
All right.
Now, let's say that you're a company, that you're one of the major companies that got impacted. Let's say that you're a travel company, or let's say that you're AMC.
Dang, how you gonna do me like that? That's cold.
I'm kidding. We'll say that you're a Carnival. We'll give you Carnival. We'll give you Carnival. Is that fair? Carnival cruise?
Floating COVID? Okay. Mm-hmm.
I can't win.
You can't.
All right. So let's say that. So Jolyn is Carnival. You're the investor. I'm the Fed.
Mm-hmm.
So I tell the world, like, hey, it's time for me. I bought up all this debt. I bought up Jolyn's debt, so that way, essentially, she can still flourish and stay afloat. Okay. And you're like, oh, okay, so the Fed's buying debt. For you, the investor, if I'm buying up Carnival's debt, how does that make you feel about Carnival?
I mean, it means that they're taken care of.
Exactly. So which means I have a little bit more, I can take on a little bit more risk and understanding that, okay, hey, Carnival is going to be okay for the most part. But let's say, for example, that, all right, now that the debt has been bought and Carnival was able to, like, that, since their debt has been taken up, then anything that's coming through, they don't really have to worry about the debt pieces yet because of the fact that I'm covering it. So which means that when we look at the revenue that's coming through, then ultimately they kind of look like a
solid company.
Okay. You looking solid. Okay. But then I'm like, all right, it's getting a little hot in here. My sheets are a little bit like, my balance sheet is looking a little chunky. So now it's time for me to start tapering off my debt, which means it's time for me to start unloading the debt that I have on my balance sheet. So now, you know, hey, Carnival, it's been real. You know, I got a good solid deal for you, but you know, I'm gonna need that bread.
Well, see what had happened was
Right.
there was a whole pandemic.
I'm gonna need that bread. So, you know, we're gonna strike up a great deal for you, in which that honestly, the repayment is gonna be very flexible, but at the same token, with a low interest kickback. But at the same token, for real, I'm gonna need that bread.
We got a buffet 24/7. Come on through, you know, all you can eat.
So now to Kiki, now hearing that I'm gonna start tapering, she's like, look, man, yo, Carnival.
It's been real. It's been real.
I know we be like that. We had plans. We were about to go to Tahiti. What's up?
Apparently Tahiti is not in the budget. It is not in the 70-30 plans.
Right.
I mean, apparently. So Kiki, the investor, is like, wait, hold up. So, you know, this whole debt situation is looking a little, you know, I'm not really feeling that. And especially if you're a value, if she happened to be a value investor, then ultimately that creates some challenges there. So now that puts you in a precarious situation there, Carnival. For me, I'm cool. My balance sheets are being like, yo, my balance sheets are becoming balanced. So hey, take it.
Dirty out here.
So now you start looking at a lot of these companies in which that ultimately their debt was ultimately bought out by, say, for example, the Fed, or it was taken in by the Fed. Now the Fed has to release that debt in order to clear its balance sheet. Because here's the reason why the Fed is not going to hold that on their balance sheet. It's their duty to start clearing their balance sheet, because think about it like this. If the Fed never cleared their balance sheet, right, and they just continue to keep pumping money, like let's take it all the way back to the 2008 financial crisis. If we go back to the financial crisis and all that debt that was ultimately covered by not only the Treasury, but also the Fed doing some significant monetary policy, and then we came over to here into 2020, that the value of money starts to look even significantly, you know, a lot cheaper than what. So for example, the value of the dollar starts looking pretty grim. So in order to build up a strong dollar and also to have strong monetary policy, now it's on to the Fed where they have to balance out their balance sheets. So here's where it becomes a somewhat of a challenge. Because remember, we were talking about those sectors, and it's very interesting that you kind of mentioned who were the winning sectors today. Because
energy, industrials, and utilities.
And it's funny because you also have some financial banks, because they're struggling because they're led to by interest rates. So if interest rates remain the same, then how do banks really make money? You know, when you think about mortgage rates, when you think about, you know, car loans, credit card debt, which is huge, retail debt is like, then essentially, you know, people are getting pretty decent rates as it pertains to borrowing, which means that ultimately that's hurting a lot of banks. Now, one of the things that banks have gotten smarter on was getting into that karma credit lending program, which they can increase the rate, but they're much more riskier as it pertains to giving out loans, or say, for example, hey, buy now, pay it later, but then at the same token, we get a higher interest rate cut. So be on the lookout for that one. I mean, if you have a financial advisor out there or something like that, you may want to look into that. Now, so the reason why it's interesting now, and the fact that when we're looking at the Fed, it would be very, very interesting. And here's some homework for the cousins tonight. It's going to be some pretty dope homework for each and every single one of you. I want you to find out just who are those sectors, who are those main sectors that the Fed has bought up an exorbitant amounts of corporate debt. That will probably make your head spin. And then it can kind of possibly give you the understanding when we look at the market sentiment of why is it that certain sectors or certain companies have been so widely loved, but then also the reason why we're in a market now where we're also starting to take in some risk here, and hence the reason why everybody's paying attention to what the Fed is going to say tomorrow. Now it really starts to come into fruition and make sense. So if we look at it, if we got the Fed saying tomorrow, hey, we're going to keep rates the same and we won't taper and we plan on tapering, you can be seeing a significant market rotation going to a specific place that was quote unquote not so loved in 2021, but essentially they start to feel more safer in these sectors. But if they say, hey, we're going to keep rates the same and we're not going to taper, then it's going to be kind of like, you're still going to see some of the same choppiness. Now, if they say that we're going to raise rates thanks to inflation, then that can trigger some things as well. So let me break it down for y'all. And then I'm going to hand it over because, of course, we need to understand, from a trader's perspective, just purely from a trader's perspective here, what would you be thinking about? How would you play it? So if we're thinking about it, right, if the Fed gives in and says that, okay, hey, y'all, we fold, inflation is here to stay, things are going to be, a little interesting, a little dicey. So now we're going to raise rates, and at the same token, we're going to taper. What you could see is that can actually trigger a market correction on, say, for example, your technology and your consumer discretionary. Why? Because that should probably spike up the interest rates as it pertains to the yield. So now the bond yield starts to look more and more enticing for, even if it's in the short term, it starts to look even more enticing. And ultimately, boom, here we are. But if they say that, hey, we're going to keep rates the same, smooth sailing ahead, nothing to see here, inflation is still temporary, but we're going to do some tapering. That can also trigger a correction towards certain things in which that have been getting so much love thanks to the fact that a lot of their corporate debt is sitting on their balance sheet.
So let me stop you right quick. So as a recap, what are the things that may cause a correction?
So if the Fed gives in and says, okay, hey, they finally have to admit that inflation is here to stay, and yet they're still going to have to admit that they're going to have to raise rates.
So inflation
raise rates due to inflation.
Okay.
Saying that inflation is no longer temporary, we see this a little bit more longer term than we expected. That could trigger a correction.
That's what the cousins want to know.
Right. But if they say we're going to keep rates the same, we still see it as temporary. We still see this inflation as temporary. Pretty much we haven't changed in our stance, but yet at the same token, we're going to be tapering. Then you could be seeing a correction or potentially a rotation out of something and going somewhere else because of the fact that now you have to add that to the expense value, and then ultimately makes you readjust the entire valuation model of what you already have set for some of these companies, now that the Fed has decided to start tapering off a lot sooner.
So those are the only two for potential correction?
Yes. I mean, because one, you have to either admit that the inflation is here to stay, and that it's here for a little bit longer, or you say, hey, inflation is we wave off inflation. Now that we saw these inflation numbers, remember when we saw, I think the market spike, I think it was last week when we saw the market spike, but we saw the inflation data there, and the market didn't even bat an eye. The market just still rotated. It literally gave not one single, feeling. Then essentially, you can be seeing, if the Fed does the same thing, then you could be seeing somewhat of pretty much a rerun to what we saw last week, but except this rerun becomes an entire season.
Let's talk about some companies that are, exempt or what have you from whatever Brother Jerome says. They're just chilling, minding their business.
Glad you asked. Don't worry, we're gonna get to the trading part. I know you want to talk about. Did you want to talk about it? Oh, okay. So what you could be seeing is, let's say this happens. Let's say that you have a company like Apple, right? Apple has $200 and something billion in cash. Now, here's an interesting thing. Some of Apple's debt has been bought up by the Fed. But Apple is the type of company where it's they borrowed money, but they borrowed it so cheaply because interest rates, one, were significantly low. And then on top of that too, it's like they had the money in which that they can just pay for it. So at this point in time, for them, cash is significantly cheap and borrowing is just as cheap.
So they were leveraging, basically, strategically.
They were leveraging, and they have the leverage because they have the cash, and then they can continue to keep printing cash. So there's that.
Smart borrowing.
That's smart borrowing. Let's talk about some not so good borrowing. Now, since I can't talk about AMC or GameStop or any of those other companies, I'll stick with Carnival. Carnival, on the other hand, or let's talk about some of these airline companies, or even Boeing, where they may have some cash, but essentially they ain't got Apple cash, and they needed a lot of. And these are the companies that needed to borrow significant portions in order to keep their businesses afloat. So it's different when you're borrowing just because of the fact that because we just don't want to spend our own cash. It's very different than borrowing when you actually need it, when you're hurting for cash and you're strapped for cash. That's different. I hope that doesn't go over anybody else's head also, because you can also apply it to personal life. So I'll pawn the replay there. It's different when you have the cash and you use it as leverage and you're just borrowing cash because of the fact that you want to keep your own cash. It's completely different to you being strapped for cash and you significantly need the cash, and ultimately this cash will keep you afloat. So you're borrowing for survival versus you're borrowing out of, necessity. So it's just a completely different vibe. So when we think about it, that means that certain companies appear more vulnerable. And so when we look at market sentiment, that can mean that the market can turn more bullish towards areas in which that, hey, though that they may even have some corporate debt, but we don't really care about that because honestly, they're good. Versus, these are the companies in which that they're supposed to be the roarback companies, but yet at the same token, they've accumulated a lot of debt in the process.
So that would signal a broken thesis for reopening.
Not exactly, because the economy, you'll still have consumers going out there to spend. We see consumer spending. We see consumer spending at a high, but yet at the same token, we also see that they're paying higher for the things in which that they're buying. Now, that's a very interesting topic because there's an argument out there by saying that, okay, hey, well, Airbnb is at a higher price premium. And when you look at Uber, riding in an Uber ride is ridiculously at a higher price premium. So now it's now you're starting to think about it when you look at it from an inflationary standpoint. Now yellow taxi cabs start to look a lot more cheaper. When you think about hotels, now they start to look a little bit more cheaper. So it's kind of again, it's a balancing act because now those hotels, they look very attractive, especially since they're roaring back with people going out to travel and being in cities and whatnot. But at the same time, they also carry a great deal of debt. So you, the investor, you have to do this balancing to say, all right, well, what's the worst that could happen? And that's where it's Wall Street, they just got through with this point of going through this period of saying, all right, well, now we have all these companies in which that just reported solid earnings. Mm-hmm. Their earnings were rock solid. And then the Fed came out right after earnings saying, hold my drink.
Hold my lemon chiffon.
Hold my drink. And now Wall Street has to go back and now readjust again after hearing earnings and guidance. And now they have to readjust again because now they have to think about, okay, hey, well, what does that payback look like? What does their debt look like now? Now their debt now comes now it becomes a part of the picture. Now, did we already price that in? Meaning that are their best days ahead of them still? Or are they ahead of some cloudy or some stormy skies ahead? Or essentially, this could potentially be the sum of all fears for some of these companies. We don't know. And that's the thing. Remember, when we don't know, the market doesn't like uncertainty. So I guess which leads us to the question, the $1 million question.
How's the trader going to look at this, Miss Kiki?
How does a trader see this? Now taking in all this information, and it was a lot of information.
A lot of information.
But, how would you see it as a trader?
So
Can we get some charts too?
Huh?
Get some charts too.
Oh.
I got no charts. Tell me what charts I got no charts.
Go ahead. As you talk, I'll work it.
So as a trader, if the feds come on and said they're going to, start tapering or, clearing off this debt, the market's going to go to the downside. For me personally, I'd be looking to short SPY or SPX because the market always falls faster than it goes up. And in my personal opinion, we got to support about 100 points down.
So let's pull up the SPX. For folks out there, they're gonna like, what? All right, so I'm gonna remove some of the stuff off the. So should I leave the 250-day moving average? Of course, candles. There you go.
Okay.
All right, so we're gonna look at the candles. All right, so here we are at candles, and don't worry, y'all, we're gonna share screen. I always forget, how do you turn Trading View dark? Where's Zay when you need him?
Where's Zay?
Wait, hold on. Can we do it here?
I don't know.
I don't know. Oh, appearance. Clearly don't give us dark mode, so. Oh, wait, background.
You gotta click on it. There you
Let's go black.
Oh, there we go.
Let's make it a little bit. There we go. All right, that's good. That's good. All right.
Okay.
Take us over.
Make it bigger.
Huh?
Where's the number on the side?
Yeah, they got blacked out. We'll just make it a little bit gray. There we go.
So if I'm looking at this from a trader's perspective, I'm pointing at the screen like they can see me.
Yeah, this guy.
Wait,
so
did you give her the mouse?
Huh?
Can you give Kiki the mouse so she can move the mouse as she's talking? Okay, we need visuals now.
So if I'm looking at the market as what is this? What's this line right here?
That's the 50-day moving average.
So 50-day moving average, I don't even know what that's for, y'all. But me looking at the downside from 42, 46, if we get to 41.90, they're going to take it down all the way down to 41.40. That's a 100-point drop. That's where our hardest support is at 41.40. So if they come on and they talk about tapering, it's a wrap. Put your bear suits on, get ready for a great day.
So 41.40 would place us right here, really at the level right before we started to go off on this glorious run in the S&P 500.
Actuals.
Well, Kiki, back it up now, because you said that was the hardest support. So I want you to explain what you mean when you say that.
So what I mean when I say that is that for the people in the audience that was blessed to take my charting course, 5 touches in the past, 5 touches looking left is where 41.40 was a very hard support level for us to break.
So across here, so 1, 2, 3, 4.
Yeah.
Okay.
That's what I mean.
All right.
All right. So if you were to think about it, right? Looking at a lot of these companies. Oh, somebody says that you are now the Negro dominant amongst us.
Wait. Never mind.
Yes. Go ahead. No, go ahead.
No, I was gonna say, Kiki, did you have anything else to say about that?
Oh.
No, honestly, I feel like nobody shouldn't be trying to predict what's going to happen. Trade what the market is showing you. If the feds come out and say they're going to start, tapering off, then at that point you need to be looking to the downside. But if they say it's staying the same, no rates, then you should see the market probably go to the upside, and 4,300 might be where we end up for the week.
And what are you basing that off of?
Because we don't have any sentiment to go to the downside at that point.
Yep, it becomes all bullish at this point. So if we go back to the chart,
make it plain for the people now.
yeah. So if we look at it here, right, for where we are, there's nothing here that's really blocking our path towards greatness when it comes to the S&P 500. Now, if we drop all the way down here, there's some rocky roads on its way to its drop until it can finally settle down to here in this level. And really, it's funny that you mentioned that, Kiki, because I was like thinking more so at the 41.15, 41.9. Oh, okay. All right. So really looking at that level. So, all right, we here. So looking at that level in which that essentially that's where you can see where there's adequate buyers that are looking to step in, which therein would trigger, like I said, a significant correction. Because then if we're looking at, let's say, the info line from where we sit today and going all the way down to that level, then that brings us to about a 3% drop. Yeah, so close to a 3% drop in the S&P 500. Now, of course, if we go now, of course, you're starting to hear some Wall Street saying a 10% drop. And okay, a 10% drop would bring us all the way down to a 38.20 if we saw a significant market correction. Though I believe that we'll probably see that towards the latter part of the year. Like, for example, going into late August, September, which is kind of like on a seasonality performance behavior. But again, we could possibly, what'd you say? Yeah. So we could possibly be seeing some significant activity here that can ultimately heat up. So this would probably stem a significant pullback down to, say, for example, like what Kiki was mentioning about almost 3% here. But then again, if you look at it from here, from a 3%, upside, though that, TradingView likes to hate on me, then that leaves us, if you think about like 4,300 from here, though that my target is more like 4,400, but that gives us about 1.4. If we go to 4,400, though again, still hating, if we go to a 4,400, then that prices us at, okay, well, that's where we're at. I'm probably guessing that prices us at, again, a 3% or 2.5% move to the upside. So plus or minus 3%. But here's the thing to take into consideration. Just because you see that the S&P 500 is moving to the downside, that doesn't mean that every sector in the S&P 500 is moving to the downside. How do we know this? When we saw that tech and consumer discretionary were rolling over, the S&P 500 was still going up to the upside. So if we go back to, say, for example, your February period of time, the market was kind of like trading choppy. But look at this. Even though if I run, say, for example, a comparison chart, if I compare it against, let's say, Apple, and as you can see, Apple
you ain't sharing screen now.
Oh, my bad. Sorry, went into geek mode for a second. But if you notice, the S&P 500 roared on. Meanwhile, Apple was going down to the downside. Now, of course, it kind of picked up some steam. But again, it's still been kind of trading somewhat within choppiness for Apple. Meanwhile, the S&P 500 moved up. Now, why do I bring up a company like Apple? Because Apple is the number one company in the S&P 500. So it represents 5.7%. Right underneath Apple is Microsoft at 5.5%. So that's already about 11% in the S&P 500, in which that you have in just two companies. Now, even though that you had those two companies not performing as well, so if I go to my comparison chart and also add in, let's say, Microsoft, and here we have it. Microsoft more so traded alongside with the S&P 500. Meanwhile, Apple has not. Now, Microsoft is up 16%. Meanwhile, Apple is down negative 1%. And the S&P 500 is up almost 15%. Now, remember, S&P 500 grows at about a 10 to 15% growth year over year. And in some cases, you get 20 and 25%. But most of the time, it's on average 10 to 15% year over year. So we're already at that marker level for where we should be reaching some of those highs. Now, can we go a little bit higher? Yes. But at the same token, again, this is kind of like in the sense to kind of be mindful of and looking at, how does the S&P 500 move? So you could be seeing like financials, industrials, and all those other companies moving to the upside, but meanwhile, technology and consumer discretionary took a huge nap. Now, when we start seeing other, like, depending on what you hear from the Fed tomorrow, you could see that it could either lead tech and consumer discretionary into a huge correction, or you have some folks on Wall Street claiming that essentially if they hear the same thing of what like the Fed just saying, all right, same as usual, nothing to see here. There is some folks on Wall Street that say that you could be seeing a 20% upside for tech and consumer discretionary. So something to be mindful of. And that's why Mary had a little limp.
Someone said, so should we be in the S&P? This is from one of the cousins in the live chat.
Do you want to take it?
Should you be in the S&P as far as what, trading it?
I mean, that's all they said. They said, should we be in the S&P?
I'll take it simply from the investing standpoint. You'll take the trading. So if you're investing in the S&P 500, which means that you bought S&P like SPY ETFs or something like that, or if you bought, certain companies for the long-term hold, then you should be fine in the sense of where, hey, I'm holding this for the long term. So ultimately, it's like this could potentially provide you an opportunity to add on to your position and, like, for example, dollar cost averaging your entire portfolio. But, if you wanted to, you can also look towards other things like, for example, commodities, or say, for example, something else to deleverage yourself, or just turn straight to cash if you're worried as an investor.
Trading S&P 500 or the SPY, I love it. It's a great beginner stock. Well, ETF index to trade. So I'm here for it. Upside, downside, we make money anyway.
There you have it. Wait, was that it?
That was the only question that I saw. I just happened to glance down and I saw that question. So normally I don't really be paying attention. But I just saw it, so.
Well, I mean, I think that we've reached the end.
We have. I do have some announcements.
Okay.
So y'all, as you know, we getting ready for the Pitch Up competition. This is our high school scholars coming out of Greenville, South Carolina, Legacy, Early College, High School. We'll have about 7 companies, aka scholars, pitch their companies live, starting at 5 o'clock on Thursday, 5 p.m. Pacific Standard Time, 8 p.m. Eastern Standard Time. And there will be judges, and there will also be a live link for the cousins to vote for their favorite pitch. So you'll be able to do that. They are competing for funded portfolio. So we got first place will receive a $3,500 funded portfolio. Second place, a $2,500 funded portfolio. Third place, a $1,500 funded portfolio. And they will be able to buy stock and watch it grow while they're in college or trade school or whatever their secondary plans are. So we're really excited about that. And, there may be a few surprises. Who knows? It's going to be a Thursday. We'll be on a good one. So this will be a special hot take where it is in live pitch up competition. Okay. So we got that. Then the next Thursday, I know you're ready, Mark. We got Rob Maurer in the building from Tesla Daily. He's going to stop on by the cookout and see what's good. We're going to talk about the nitty gritty Tesla, everything. So wear your red, get ready for that. And was it, there is another announcement, Mark.
What?
I know you have a nice announcement that you would like to make.
Yes, for those of you that don't know, I have officially stepped down as managing partner from venture capital, which means that essentially that, I've served as managing partner for Red Eye Venture Fund for 5 years and 2 months. It's been a hell of a ride. I've had the privilege of investing in some amazing companies that are doing some pretty dope things, especially with the AI and machine learning focus. That are looking to make significant changes in the world. But my time has come to its end. And I'm pretty excited for many of the new things that are coming into play. Also, the fact that I get to spend more time with my family and do those things. Like my wife, she gives up a lot. So I think that she's in the chat. So I think she said something earlier that I kind of like missed while I was geeking out. So shout outs to my wife, Erica. But yeah, so it allows me to also, you know, be able to do more content creation for the Come Up series, along with some of the other great projects that we've got at Red Eye Studio. I think my biggest thing was I just, you know, it was my walk away. Like for those in whom much knew that I walked away a while back, but this is ultimately a walk away because I put a lot of like heart towards what is it that I did as a venture capitalist to try to make a significant social impact. So it was truly a blessing. It was an honor to be able to say that I've had that privilege to do that. I can't wait to, you know, bring some of my world into the Come Up series world. I think that that's going to be amazing, even if it means unveiling more startups to each and every single one of you so that way you can understand it and maybe even have some startups pitch on the Come Up series live for each of you so that way you can understand how it works and see exactly how we also dissect it as, you know, VC investors. But yeah, I mean, I appreciate everybody who's given me the warm felt congratulations and also heartfelt messages. It really means a lot, especially when you think about the amount of time that I put in. And what is it that I also had to do to go through that process as well. So thank you. Thank you. And as I raise my glass, here's to new begin. Here's to new beginnings.
Yes,
and new chapters. Hopefully that doesn't explode.
What is this?
Sparkling water.
Negative.
All right. So I guess we got to get up out of here.
We do. It's 7:03. You already know I got plans. So, yo.
I know. Shout outs to our moderators, Tivo and Kayla. Kayla, you do a fantastic job.
Thanks,
in
y'all.
moderating. Thank you, Kiki, for stopping by. I know that the folks at Stocks to Freedom is like anything that you want to say to the people.
No, y'all, just keep pressing, keep learning, keep growing, get better.
I like that. I like that. Jolyn, anything left?
You know, it's jolyngc in the place to be, and I'm ready to get up. O-U-T. Okay.
And I'm Mark Monroe, and this has been your Come Up, aka on Trade Talk Tuesday. We are so excited for Thursday because it's not going to be a hot take, or could it be? You may hear some hot takes, but it's going to be an amazing show because you get a glimpse of what the future looks like in the present. Until next time, we'll see you guys on Thursday. Have a great one. Be kind. Keep researching and learning because, like Kiki says, the more you learn, the more you earn. All right, y'all. Peace, y'all.
Did he freeze?
Yeah, we're still live. What's up, Timo? How you doing? Holding it down in the back office.
I mean, you know how
you
I do.
At our Midwest headquarters.
That's a fact.
Yo, okay, so shout out to Square.
You in Square?
I am.
Okay.
Heavy. We are still live. This is hilarious. Yo, let me see. I'm about to stop the stream, but I'm gonna hit you up afterwards, okay?